Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to Jonathan Hunter, CEO of Eleco, and CFO Neil Pritchard, a leading developer of project management, Buildtech, and visualization software. So welcome, guys.
Hi, Paul.
Thanks for having us.
Yeah, well, big congrats on today's record first half results and positive outlook, with adjusted EPS increasing 24% to 2.1p on the back of a 12% like-for-like increase in revenues. But before we run through the details there, Jonathan, I don't suppose you could just quickly remind the audience exactly what the company does, its sort of key USPs, and the sort of secular growth drivers behind the business.
Yeah, happy to. Thank you. So Eleco, just as a reminder, is a specialist software business that's focused in construction technology and prop tech or property technology. We service customers throughout the world. We're headquartered in the UK. However, we have operations throughout Europe, in Germany, Netherlands, Sweden, and more recently Romania, but also a growing business out in the US, and also we have some colleagues in Australia where we're also servicing the market there. Probably in our home markets of Europe, we're very well positioned amongst general construction contractors, manufacturing businesses, all the household brands and names you know in the UK. You are most likely using our software, as well as public sector customers like the NHS and police departments. Key, I guess, unique differentiator with Eleco is that the products are best of breed. They're feature rich. We've got a proven track record of supplying to customers over many years, and they love what we do. They love the products very much, and therefore they're very sticky. We're also of a size where we're quick to respond to customer needs, which is also driving that stickiness of product. And as I mentioned earlier, we're diversified across construction tech and property tech. So, post-construction operational phase of the building life cycle. And we're positioned in multiple geographies. So therefore, we're a resilient business with high recurring revenue growth. That's been the key driver we're seeing with this set of results, and we continue to focus on that recurring revenue and predictable revenue.
Yeah, and I guess one of the key sort of secular growth drivers is that whole shift to digitization of building and infrastructure, and having that sort of like digital twin of a particular property right through its sort of like full lifespan of sort of maybe 75 years or so.
Yeah, absolutely. We're in an industry that's being criticized as being a laggard for adopting technology, but actually what we're seeing and what's very exciting is that our customers are adopting a lot of technology, but the industry as a whole is also becoming more complex. There's more demands on the complexity of buildings, the sustainability, the safety, and also environmental factors of buildings and structures. So with this complex demand, the demand for structures and buildings and houses through population growth, our customers are really challenged to deliver on time, to a cost, in a safe and sustainable way. And that's really what Eleco is providing, is scheduling. So all the time and task aspects around a project, cost estimation and visibility and data and compliance, and then post-construction, that maintenance and predictability, ensuring that the property or the asset is efficiently operating and safely operating as well.
Yeah, and what's sort of the demand picture at the coalface there, Jonathan? I'm guessing it's pretty strong, particularly as the world needs more infrastructure, or certainly to upgrade the dilapidated buildings and all those kind of properties we see around the world, in fact.
Absolutely, there is a growing demand, and there's also tools and data is required to manage these complex projects. And the reason why they're complex is that we're bringing so many different parties and disciplines together to deliver a project. Add to that price volatility around pricing, material prices, labor shortages, and then safety and environmental factors. We're seeing, we're fortunate that we have a good position in Scandinavia and the Nordics, and they're very far advanced in terms of environmental policies. So we're one of the recommended estimating tools in Sweden because we provide carbon estimates through the software, and we see that demand and trend flowing into other regions as in terms of estimating carbon, but also managing and ensuring that buildings are built and operationally efficient in the future. So there's several drivers that I've just mentioned that that are really adding to the complexity, and therefore customers are driving or leaning on technology such as what we're providing to deliver that.
Yeah, well, it certainly will keep you busy there, Jonathan. Now, moving to the numbers, Neil, can you just take us through the sort of the key highlights? I did see ARR jumping up significantly, and also the NRR as well, the sort of like the indicator of more gaining more customers than are churning off.
Yeah, no, absolutely. Thanks, Paul. Yeah. Well, yeah, if we start with the ARR, we're really pleased and sort of proud to present the numbers. That's actually moved up the ARR as the exit recurring revenues as we sort of finish that 6-month period we're reporting on, times by 12 to annualize it. So we've seen that up 31%. The recurring revenues across the whole of the 6-month period, they've gone up 24%. And actually total revenues have while previously in the previous half we'd in the comparative period they'd actually gone slightly more ahead than we'd anticipated when we were going more through the SaaS transition back then. Now we've moved meaningfully ahead on the top line revenue as well. That's increased by 21% to 16.3 more on constant currency basis. And even with acquisitions like that's more than double digit, sort of 12% growth on the top line, which is great. But I think the other thing that's really coming through now for the first time, as we're moving now into this final phase of the SaaS transition and beyond, is really the profitability and the operational leverage that's coming through. So it's really pleasing, whatever measure you're talking about, really. So I mean, just a few things. For example, EBITDA is up 30% to 3 million. Operated for the 6 months, operating profit up 36%, profit after tax up 30%. So really pleased with that, and obviously that more is coming through therefore to the bottom line. You mentioned about net revenue retention. I should come back to that. Yeah, that's at 108%. So I think anything over 100%, I think is viewed as a positive, I'm sure, and meaningfully ahead against the previous period as well.
Just for investors, the NRR, in fact, if I'm correct in thinking, it basically implies that you're making more money from the from that particular customer, i.e., or you're generating more income, increasing the share of wallet.
That you couldn't have put it better yourself. Absolutely, it's about growth in the existing customer base on all sources of growth, through all sources of growth. Be it, we've got new feature enhancements, new modules. They're expanding, we're expanding with them. That the rates of depth of adoption are greater, price increases, mix increases, and so on. So that it's everything in there. So it's a share of wallet, as you said, which is great. And the OpEx, while that's moved sort of significantly ahead, more than half of it is actually down to the absorption of the cost bases of the acquisitions. Best Outcome, because that only came in the second half of 23, not the first half. That's a comparative period here. Also Vertical Digital in Romania that Jonathan mentioned as well. So, and then outside of that, there's some one-off sort of acquisition related costs and things, and beyond that, it's really sort of headcount inflationary related. Cash flow is really good. I'll come back to that a little bit more later, maybe, but I mean, essentially...
No. Could you just take us through? Because I mean, that was a real standout. I mean, effectively, I saw on your adjusted cash flow, it was double your adjusted PA, your profit after tax. I don't know how you managed to do that, but I've never seen that. It was just outstanding.
Absolutely right. It's double. It's double at 3.2 against 1.8. So that's really, really positive. And we always are a cash-generative business, and I don't want to sound complacent, but yeah, we've had some meaningful improvements on that score as well. And then I suppose probably to top it off, with those sort of levels of increase and so on, and after tax, of course, then we're actually sort of progressing the interim dividend by 20% as well. So again, to reward our our valued shareholders and our potential shareholders as well.
Brilliant. Okay, good. Now, Jonathan, could you give us a quick update on the sort of the go-to-market strategy? Obviously, you made good inroads across the world, but say starting to now, say in the US, and you sort of your thoughts on using direct and sort of channels, etc., cross-selling of particular products. Anything in terms of the go-to-market side of it.
Yeah, we are continuing to develop our reputation and brand position in our markets. That's been, a key pillar to our go-to-market strategy. We're developing as a trusted partner in the built environment, and that's actually doing several things. One is attracting new top talent to the business, so with some new senior hires starting in H2 of this year. Sales and marketing focused hires, I should add. But also, we believe that the built environment and the challenges that our customers face can't be solved by any single provider. And therefore, we do need to be well positioned as a trusted partner in order to really deliver value and service to our customers. And we're also enhancing that through improved customer success techniques and online self-development and learning management systems. So there's quite a lot of customer-driven, customer-focused delivery as part of our go-to-market. In terms of direct versus channel, the majority of the customers are serviced directly by our own people. And we've found that that's delivered the best or the highest retention rates. We've been able to expand those accounts in a better way and really service those customers in the best way possible. So, the focus is still direct sales. In the US, you mentioned being a market where we've been positioned in the US for several years with channel partners. We're actually last year we introduced a direct sales and direct to market capability, but that's alongside the channel because the market and the opportunity is substantial there, and we believe that that there is quite a large geographical spread as well, and working with the partners there is certainly a lot of opportunity to pursue. In terms of our go-to-market there, though, we've increased the amount of marketing spend in the US. We've also increased the number of people. I think we're up to about 7 colleagues out there now, and we're continuing to add new logos. But it's important to highlight that the sort of go-to-market strategy or the way we operate is that new logos will join. They'll take a handful of licenses or a bit of software and use it on one project or 2 projects, and then they'll expand and continue to expand over time. So we see it as a journey in the US, but so far the feedback has been really encouraging. When we're hearing such great feedback about the product that we're offering in the US, so that's great. So we're just continuing that, and we'll continue to invest in the direct market as the opportunity and the demand expands.
Yeah, good. Okay, well, let's move to the recent acquisition, Neil. In terms of the integration, how are we standing with Vertical Digital, and then also just more broadly, sort of top level. So what you're thinking of with M&A, because obviously you've got a big sort of cash, not mounted, but you've got a big cash balance on your balance sheet.
Yeah, no, certainly. We're conscious that while it's nice to be in that position, of course, many companies aren't. It's equally, we will put that to good use. But to come back to your first point on Vertical Digital, I think the integration going very well. That remaining acquisition we made, a couple of companies out there for about 1.1 million for the main consideration outside of acquisition related costs. It's been progressing well. It's a quick reminder, I guess, for your viewers that essentially there was kind of a capability play You know, they through their experience with other multinational customers, they have a sort of other slightly enhancing and additional skill sets to our own in-house very capable capabilities. So it's kind of a cross-fertilization, if you like, of ideas and skill sets, which is great. So that is much more agile. You know, we're finding that they obviously work incredibly hard and really bring some new things to the table, which is really encouraging for, you know, purpose, you know, mainly for our internal roadmap, which will allow us to accelerate things, you know, and develop things quicker and provide, you know, those customer-centric solutions and offerings that, you know, will keep us both ahead of the game and take us further ahead of our competitors. So we're really pleased with that. Regarding the future M&A strategy and using the cash, I mean, we're always looking. We outlined a while ago, and Jonathan did, around the sort of the various types, but broadly speaking, without going into the details of the types, you know, what we're looking for is, you know, is great people, great innovation, established sort of successful businesses, but they're looking to expand and get to the next level and, you know, join a really good cultural sort of family, you know, the Eleco family, and looking to expand, really playing to our sort of geographical strengths while also looking at perhaps sort of adjacent nearby markets as well geographically, but obviously still within sticking to the knitting, broadly speaking, of you know, the Contech PropTech area that Jonathan mentioned. I think for us, it's got to be, you know, always said, but it remains a universal truth. It has to be a compelling strategic fit for us and enhance shareholder value. And yes, we will deploy cash and, if necessary, go into debt. And if there's something transformative there, who knows? But you know, but yeah, we continue to identify and review opportunities. I think the market's still really good for that, and you know, we're constantly looking at things like that. So it's very encouraging.
Yeah. Well, I mean, as a long-term shareholder, you've done a great job with a lovely track record of buying. And if you could ever find a carbon copy of Eleco out in the in West Coast or East Coast down in Austin, Texas, or something like that, then I would certainly help fund that. That's for sure. So that'll be a lovely position. Okay, just want a lovely segue also into your new products, Jonathan, because you've been to a lot of heavy lifting there in terms of your AI and also with your the real time sort of project management software you're putting. You just give us a bit of color on that, and also what the roadmap is going forward.
Yeah, it's been really an exciting first half, actually, because as you say, we launched our generative AI tool that helps customers find responses and answers very quickly in a very structured way. So that's been really well received. In fact, the queries have overtaken that of our support desk, and customers are constantly saying how you know, time saving that is. That's the Aster GPT application, but also excitingly the Aster Vision Live platform, which is bolting onto our scheduling platform, but it's actually giving live real-time capability, allowing multiple planners or project managers to collaborate on a schedule. And what's really unique about it is our R&D team have developed a way of spooling up a secure instance of a schedule or a project, and instantly, like within a few seconds, start using and collaborating on that. That enterprise environment traditionally took quite a significant amount of time to set up. So, you know, really that's resulted in you know, some customers that may have been looking at Vision and contemplating it, they've actually seen that and pressed the button and implemented it. It is an area of our sort of portfolio that we see continuing to get more interest as our customers are looking at AI and looking at historic scheduling data and trying to identify the quality of that data to feed AI. Aster Vision provides that quality from day one, so it's, you know, prescriptive and standardization across all projects within their portfolio. So we're seeing more interest in that application, which is really exciting.
And presumably, given you, if you build or create a digital twin of a massive building or huge infrastructure, then handing that over to the owner of that to improve the efficiency of managing it is pretty valuable, I would have thought. So there must be some opportunity to improve performance for the new owner of that asset going forward.
Yes, absolutely. You're right, Paul, with the use of BIM, so the building information modeling, the 3D model. Aster, our solution, integrates that into the time. So at any point in time, you can see what was planned in 3D, but also as you're progressing through delivering the project, what actually happened on site in 3D. So that data is very, very useful, not only during construction, post-construction, and then, of course, throughout the ownership of that building. You can identify who installed what and on what date, for example.
Yeah, well, hopefully it'll be a nice growth opportunity, another one going forward. Then just in terms of sort of the outlook, Neil, just a quick update on how you see the sort of second half. You must have got, given you've got 74% recurring revenues, you've got pretty good visibility over the last 4 months, I imagine.
Yeah, I mean, that's one of the benefits, absolutely, of the recurring. You get that sort of predictability and that sort of future look, I guess, as you say. So for both investors, but for ourselves, of course. Yeah, no, it's look, we continue to see really good momentum in our trading businesses. In local currency terms, they're all advancing. As Jonathan mentioned earlier, there's so many positive sort of industry drivers, if you like. Rates of adoption, be it digitalization, AI, or whatever. So yeah, so we see I guess. As we've said, we're trading in line clearly to meet the full year 24 expectations, market expectations, and we're very positive in our outlook on all of that. And I think the dividend itself, and I've only obviously mentioned the interim, and there'll be a final, obviously, but that's really an underpin and an expression of confidence as well, and as I say, a thank you to our shareholders. So yeah, it's looking good. Thank you.
Brilliant. Okay, and then just finishing off, Jonathan, I suppose you give some quick sort of messages for investors over the next few years. I mean, you've personally put so much into the business and shaped it and literally transformed it and dragged it into the 21st century over your sort of 10, 15-year career. Where do you see the next 10, 15 years?
I think the next 5 to 10 years is going to be completely different to what we've experienced in terms of our industry of technology adoption and usage in the built environment. So it's really an exciting period ahead of us. I think, in terms of the outlook for Eleco in particular, this year and beyond, very confident about the outlook, primarily due to the talented colleagues that we have within Eleco, and we continue to attract. We've got incredible customers that are challenging the way they work, that challenging the way we build and maintain properties and structures. And we're in this environment that's transforming and rapidly adopting technology and data and trying new things. So, the future is looking really bright for us. I think we're certainly focused on ensuring that Eleco is well governed, and it's a good platform that allows us to continue to invest in R&D, allows us to continue to invest in servicing our customers through go-to-market capabilities, and also for the right opportunity, make an acquisition that's value enhancing for our shareholders. So, I think that is the sort of key to our strategy, is ensuring that the business operates and runs in a very well governed way.
Yeah, I mean, I've been a shareholder now, Levy, for a decade, and I've never seen the business in such good shape. So I tip my hat and thanks very much for doing that, Jonathan. Okay, then, guys. Well, thanks again for the update and the terrific numbers, and look forward in touching base towards the back end of the year when we have a sort of like a year end, probably in January, I guess.
Yeah, usually January, exactly. But there'll be we'll talk again around the trading statement there. So yeah,
cool. Thanks, guys.
Thank you.
You.